Hi, everybody. Thanks for joining us. I guess today the agenda is that we're gonna do a very short talk. I'll try to keep it down to 30 minutes. So let's see. So this is Rodney's our CEO. He's gonna talk a little bit about Avalia, and we're bringing a couple cases and talking about the application and the impact of tech in business. And then this gentleman by my side is Pedro. So he's actually the director of London Cambridge Business School. And then hopefully you guys will enjoy some good food and networking. Pedro, would you
Should I introduce myself?
Yeah. Do you need it?
Oh, actually, no, I have the mic.
Yeah.
Good evening, everyone. So I'm probably here as the boring academic that will keep people's minds focused on cash flows, profitability. Hopefully, Rodney and I discussed about the content, talk a little bit about the impact of this new environment with higher interest rates will have on valuations, the ability to fundraise, and so on. But just to give you a little bit about me, so currently I'm a professor of financial economics at the Business School in Cambridge, and I'm also the director of our Masters in Finance there, so teaching MBAs, executive MBAs, and so on. And my research is mostly on valuation, fund performance, a little bit of everything. And Rodney and I go a long way, so he invited me to be here today to talk about what's going on in this crazy world of ours. So looking forward to hear your questions and to have an interesting evening. Thank you.
Thanks, man. Well, first, thanks everyone for coming. It's really lovely to be here with you. It's great to be launching our business in the UK. I am Brazilian of origin, but I'm also British. So even though I live in Switzerland, it's just really, really cool. And we wanted to do this earlier, but COVID kind of held us back a little bit with this plan. So it's just a great joy to be with you here today to do this. A little bit about Avalia. We've been around for, it's our 7th year. Our roots are in the research in Switzerland. My co-founder has 15 years of research in software analytics. And I came from the business side. I do have a background in computer science, but I went into the dark side early in my career and started working with money and finance. So you can't kind of get away from it once you start. But it was a meeting of minds where we looked at the research they were doing in software development and valuation and investments in technology. And we created the business, and it's been going really well. We have a group of people in different countries, and we have a network of experts. So we have the ability to actually work in very big projects, like we did NASDAQ listing due diligence. We did very big carve-outs. We work with banks, insurance companies. So even though we're small, like one of our clients told us just yesterday from one of the stock exchanges, one of the largest stock exchanges in the world, they say they're really small, but they're the best at what they do. And I really liked what he said. I'll take that. I like to believe that. And Pedro is here to keep me honest with the numbers. He's the independent guy. What we do, we can break it in 3 areas. The first one is it's a due diligence work. It started with transactions, but it also works with partnerships, and of course, mergers and acquisitions beyond private equity and VC. And we will do the software due diligence for a transaction. We'll come in, we'll have a look at the target, do a certain analysis on the technology bit, and it will provide a report and recommendations. The other thing we do is from a sales side or an operating perspective. So the company operates, has a group of people developing technologies, launching products. We'll actually help them improve their performance and be more productive and improve the quality, the speed of development, and so on. And we can do this. I used to joke that transaction is like the Formula One pace of things, and then you bring that pace to the operation, which is a little bit longer cycle, but we just come and say, look, we can do this in a number of weeks, not a number of months, and that's thanks to the technology. And finally, with some clients, we have a longer relationship where they say, hey, we really like the advice and we like the assessment, and we want to have a continuous assessment on some of the roadmap and improvements that we have. So then we stick around, but it's usually for 1 to 3 years max, and we try not to do much longer than that. So our relationship, it's always at maximum impact. After a certain while, you've told them they either did it and things improved, or they didn't do it, and there's no point in telling them for the 10th time. So we try to keep it moving, keep it fresh. So how do we work, right? So one of the things that happens in technology is that the language of technology has been from technologist to technologist, and it's really being close to that group. And if you understand it, then you can get what's going on. But if you don't live it, then your knowledge has a shelf life that's quite short, because the number of new frameworks and technologies coming to market, it's staggering. So it's really hard to stay up to date if you don't work technically, if you don't live that. And of course, the investors, the business side doesn't have the time. People don't have the time to be doing technology. So even the investors that have a technical background, they start missing out. It's hard to stay up to date. And then when we go talk to technical people, oftentimes they don't have the language of the business. So there's not a good translation, and they will be talking about, oh, you've got 320 years of technical debt, and it's like, what does that actually mean? Or you've got cyclomatic complexity. That doesn't mean anything to the business. So you have that asymmetry of information that leads to suboptimal decisions, right? And that's where we started. We said, okay, let's talk the business language. That's the main thing. What are the business goals? How do we translate the technology? And then when we look at technology, the other thing we noticed is the past 15 years, there's been a lot of development in analyzing software, analyzing development, but it's very narrow and deep. So we go security, and you have systems that will analyze very deep and very narrowly security. But then again, how do you bridge that to the business? And moreover, the product is a result of a process, a development process, decisions being made. So the product is were things done right, but the process is, were the right things done? How were the decisions made, right? And ultimately, everything boils down to the people. What is the quality? Is the team complete? What's the experience? How are they organized? And there's this Conway law that said the system will look very much like the organization and how they're structured, right? And this guy discovered that with Rolls-Royce, actually. And engineers were sitting together, the guys doing the brakes and doing something, and he could see the pipes in the car were very similar to how people were actually sitting together in the office. And you can see that in software, right? And so we took this more holistic approach where we integrated and we built a lot of technology around this analytics, but we don't stay narrow. We really broaden, and we do the work through the software, and then we translate that to business. And the way we do this is by mining data that's there. If you're working with software, everything you do is registered, leaves a footprint. There are all these breadcrumbs all over, right? Who coded, when it was delivered, when was the idea first conceived? Was it delivered the first time? How long did it take to, all of this data is there, but it isn't being explored much beyond the people using it on the daily life. So we build the data mining and we put it into visualizations. We'll talk a lot about visualizations today. So that's the way to translate this complex data into something simple that we go and okay, I get the point. And then we drive the roadmap and we say, okay, here are the things you need to do to achieve the business goals you set out, right? And now we'll talk a little bit about the market, and Pedro will help me out here. And the analogy I like to make is before the thing with the market, it was the tide was rising. And when the tide rises, all boats rise with it, right? So the decision was about, in finance, what we call beta, right? Where are you going to, in what segment do you gain an edge over the overall market? I want to go fintech, I want to go ad tech, I want to go med tech. Okay, so that's where you're searching the beta, but you're not really too worried about the boat itself. You just want to get in because you don't want to lose the timing. So you saw like SoftBank and Masayoshi Son say, hey, I'm really sorry. I was too greedy. I don't think that's a thing in Japan, big leaders going on and say, hey, I was greedy, sorry. It was messed up, but it was the hurry. They were trying to be on the wave, catch the tide. But now the market turned, right? And the tide is dry. And what do? Then And if you want performance, because if you want to drive value, it's the alphabet. It's like how the particular investment performs better than the rest of the market, right? So you really have to get your hands dirty, go into the boat. So now it's a good time for us, because before we would talk to deal makers and investors, like, I don't care, just want to buy, just want to be in. And I was like, it's hard to make money. I want to be sure that these guys can deliver what's being promised. And that's where we come in. So we had this to illustrate that, right? And Pedro, maybe you can comment a little bit on this chart.
Yeah. So everyone, I think Rodney was showing. So this shows what happens with the S&P 500, so the major stock market index in the States, in 2020. So that was the year of COVID, right? So each of those dots there, they represent one particular company in different segments. So for example, we can see energy there being really negative. So in 2020, because of COVID, remember what happened with oil prices and so on, they went down. So lots of energy prices, companies were really underperforming. As we were all home, tech companies and consumer cyclical shot up, right? You can see Apple, Microsoft, Amazon, think about Zoom coming out of nowhere. And I think this is just showing, I guess, highlighting what Rodney was saying, that when the tide is rising, even if you are not too good on the types of companies you invest, you end up making money, right? And I think Warren Buffett once said something similar to that. When the tide goes down, that's when you see which companies are with their pants down and unable to survive. And this is something that has happened throughout all of the crises that we've been through, whether it's the tech bubble 2002, 2007, the global financial crisis. This is probably what's going to happen over the next 2 or 3 years as things get really nasty with the increase in interest rates. For all of us living here in the UK, the situation over the next couple of years are going to be pretty bleak. I mean, we all heard and read what's going to happen with our taxes and disposable income. And that's why it becomes even more important to focus on the product of a particular company and what is the difference relative to the market, to be able to raise funds, convince investors that you can withstand the low tide, and hopefully once things get better, you are back to growth on mode and carry on.
And this year, right? This year looks quite different from last year, right?
And that's the one that we see kind of the opposite. The war in Ukraine started, so you can see energy really shooting up as energy prices went sky high. We started seeing tech companies and consumer communication services really underperforming, in the same way that we probably had some over exuberance back in 2020. People now were getting back to normal and starting to sell, especially about Microsoft, Apple, and Google. Everyone is actually beginning to underperform the index, and which again shows the importance of how being at the right place at the right time matters. Now, given that we don't know how long this recession or even inflation will take to go back to normal levels, we must be able to choose based on the alpha or the individual products of a company, rather than just going with this blind approach like many PE funds or VCs of buying 30 companies in a particular sector, counting that one of them will be the next Google, and probably one of them with the tide rising will become really overvalued and making a truckload of money. Asset selection now, it's a lot more important. I don't know if you saw last week or early this week, the Vision Fund from SoftBank, they reported losses of about $10 billion, I guess, dollars in them, thinking about all the losses that they made with FTX, and they were only rescued because they sold a big chunk of Alibaba. But again, if you are thinking about all of this from an investor point of view, now is when having the right investment strategy and investment model becomes super important. That involves having proper due diligence, thinking about how your company will grow, because, and maybe Rodney will start talking about this in a second, if you don't have your strategy right at the takeoff, that's when things get nasty. If you think about airplanes, for example, if you think about airplanes, I think that the statistic is that about 80 or 90% of plane crashes take place either during the takeoff or when the plane is landing, right? And that's the critical time to avoid making mistakes. And I think whether you're talking about what happens right after an M&A or with a startup, that's the critical moment. So if you start losing 2-3 months, you start reducing a lot your value because time starts to run out. You're going to burn all the cash. All of the nice products that you are hoping to launch have to be postponed. And that's when valuations start going up. Let me shut up.
And it's the same thing with M&A, right? Because there's immediate liquidity. So the first time you report the numbers, if the acquisition is not starting bringing traction and changing indicators, people are like, okay, why are you doing this deal? And what's the thing? But let's look forward, right? And IDC a couple of days ago launched, it was this week, they launched this research and they gave 10 predictions. And I picked 3 that I liked the most, and they're more short-term, 2024, 2026, right? And all of them are talking about technology as a way to get out of the crisis. It's technology innovation that will drive the top performers forward. And then when you look at 2026, is the ability to sustain innovation, digital innovation, that's going to make the leaders. So it's technology innovation that's going to get the leaders out of the crisis. It's sustaining innovation that's going to keep them leaders. And then integration, being able to partner and join data to come up with new products, that's going to drive growth 10% faster. And you compound that over a number of years, that's an immense alpha creation. That's where you perform better than your peers. That's where the rubber meets the road, actually. Like, that's how you create value, right? It's all around execution in technology development. So technology now is critical. It's a strategic capability. But how do you evaluate this, right? So I want to show a plan here, a model that's very simple. It's very easy to understand. Imagine that this company, okay, has a plan to launch 1 product every 4 months. So 3 product launches, January, May, September. And cumulated over the year, it adds in average $1 million. So the first product launched in January, by the end of the year, provided 12 million extra in revenue. The second had 8 months, another 8 million, 20. The third, 4 months, 24 million. So by investing in innovation, you have a team, they're developing new products, they're launching the products to market, and they're generating this growth. This is a very simple model, the different curves, but that's just for us to be on the same page very quickly, okay? So you imagine that. Okay. Now, to do that, you need a team of engineers. That's the biggest investment. Nobody builds data centers unless you operate data centers like Amazon. So it's all in the cloud, it's all somebody else's CapEx. For you, it's just operational costs. So the bulk of the investment is the team. So let's imagine you have 100 engineers developing. Today, you organize them in squads. I don't know if you've heard of this, but these are small autonomous teams. They're supposed to deliver value and, join their data and their information with other teams. Very much like companies have to do with other companies later in order to create new innovative products and drive that 10% extra revenue growth, right? So that's already happening inside. And the break is 100 people, let's imagine in 10 teams of 10, and every person costs the company 10K. So that makes 12 million investment per year, and you generate 24 million in additional revenue, and that compounds, okay? And then comes the crisis, and the board says, hey, we need to cut down. And hopefully it's not Elon Musk, because he's saying, I'm going to cut down 50%, right? But if it's Meta, they say, well, let's cut down 13%, 20%. What do you do? And the first thing you need to think of is that not all engineers are the same. So I'm going to show the same way we visualize the data for the market, let's visualize data for engineers. And I'm going to show one of these little squads, and it actually has 6 engineers. And for every engineer, we mapped, based on the data that's in there, we mapped the code files that they created and they modified during the year. So we see what every one of them has done during that particular year, right? And that's the kind of picture you get. Now you have to cut people from this team. Who do you not want to cut? It's not a hard question. When you see the data, it's pretty easy. Now, you need more context. Maybe Watanabe is doing, I don't know, painting buttons green, and there are a lot of buttons in his, so maybe it's very simple work, and this person here is doing the most complex machine learning, and that's where it drives most of the value. So the data alone doesn't give the answers. It just brings questions. But they're the right questions. So you ask, okay, what is his profile? Experience. The other question you ask is like, is this documented, or is this all in this person's head? Because if it's all in this person's head, then you definitely don't want to lose. And by the way, this is real data from a transaction. The names are different. But this was the person that had left the business looking for an investment. And for a year, they hadn't changed anything because the only person that knew how to change something was the most senior engineer that built the thing and left. Now, if you have the data, it's very easy. But if you don't have the data and you talk to the CEO, I talked to the CEO in this deal. And I didn't ask, oh, was this person important? I mean, you do. Yes, it's a dumb question, right? The question was like, how? Why did you let this guy go? And he was like, oh, I didn't know. I didn't know it was like that. They were all working together. How could I know? You have to look at the data, right? But you need the systems, you need the process, you need to know how to do it. So what's the consequence in a bigger context? In a bigger context is, imagine this team, instead of delivering their work in 4 weeks, now they start delivering in 6 weeks because they lost their MVP, the most valuable player. And it's hard. And it's just harder for them to deliver. There are dependencies. So other teams are saying, hey, ship the work. Well, it's not working. We have a bug. We need to delay. Now these other teams are waiting. And then there are other teams waiting on them. Now, if you just add and cascade, and the rate of delivery moves from 4 weeks, you're shipping things, and you're finishing jobs, and it moves to 6 weeks. What's the impact? And how does that look like in the data? So when we look at the data, so this is a little bit more complicated visualization, stay with me. It's a Sankey diagram that shows from here to there. And you have to do, doing, this guy's had a validation period and done. So you see here and say, oh, I have to do this, and then it's moving to doing. And then when I'm doing, well, guess what? A third of the things I'm doing go back to do. All of this work is waste. Now, it's natural to have a little bit of waste. Sometimes you change your mind, there are new priorities, there's a bug that stops everything. You don't want to stop a third of everything you do. We had a case in Germany with over 60% of the German engineers' work, and there were a lot of engineers. 60% had to be redone. That's where the questions become interesting. It's like, well, you guys, you're not shipping. Why are you not shipping? Oh, we are organized in a certain way where the people that make the screen look nice don't understand the data behind. So now we have a screen to show information that doesn't exist in our database. And that's because we're organized in a way that we don't talk to each other. That's a human problem. So you can't only look at the system, you have to look at the process, you have to look at the organization of the team, and then you see this kind of anomaly. You already know that the promise to ship products post-investment is not going to happen unless this gets fixed. It's just a third of the money invested being thrown away. And in the acquisition, it's not only the money of the acquiring, it's all the money that's going on in the corporate to absorb that and being sucked into this inefficiency. And guess what? The first 100 days are the perfect moment. It is the perfect moment to make these changes, to put it on the table and say, hey, we have an independent party, we measure this is data they put. If it's not correct, then they're not measuring their work correctly, it's even worse. Let's go and improve this. That's the time. And what happens is, if they're not shipping in 4 weeks chunks, they can't deliver 3 launches. Therefore, they can't bring 24 million anymore. So now they launch every 6 months. And they have 12 million and 6 million. So they have 18 million. 6 million got lost just because of this delay. Because you lost one guy and you didn't have documentation and you didn't replace, and that cascaded and the chaos started building up, and that's part of what we call technical debt. So the technical debt builds into the software, it builds into the organization, and it starts to accrue this interest in what the company is capable of shipping, right? So
maybe you can go back on that. So I think there are 2 points here that I think it's interesting. One, it's not a financial one, it's more like a strategic one and so on. So if you look at this, especially say in the context of an M&A, you're thinking about strategies and what you're going to change after you acquire this or that company. We can see here the importance of actually already having a strategy for your human capital policy, right? Remember the takeoff analogy that I was mentioning. I've seen quite a lot of strategic plans and so on in which people haven't really thought hard about what is the right person for the job after the acquisition, right? I think many of us here, we know sometimes we plan a big change and we only worry about who to hire after things start. And we might end up losing 3, 4, 6 months just until we find the right person, especially in tech with the competition for talent and so on. So, and this is something that should be planned in advance and probably given a lot more thought than we currently see out there. The other point is more on my side of things, thinking about finance, right? At the end of the day, the value of any company is going to be based on what? On the future cash flows that this business is going to make. It might take 10 years to make the first profit like Amazon, or 20 years, but at some point, all of this money is only going to come in if you can convince investors that there is light at the end of the tunnel to generate this. So if you take a look at something like this, any delay at the critical takeoff stage is going to cost a lot of money because of the compounding effect, right? So in this particular case, since this is a fast-growing business that in the business plan is selling the takeoff in this particular way, just by wasting 6 months or 1 year, this will have such a big compound, not only on the future profitability, but also on the burn rate and the cash flow expenditures of this business. So if you are an entrepreneur there in reality, and you haven't had a proper business plan, what's going to happen in that time right now? You start seeing your cash balances going down. You're not too sure whether you're going to be able to find VC or PE funding or someone to acquire you. So lots of companies with good ideas and good products, they might just fail because they run out of time. And during, let's call it the good old years that we observed in the past, it was easy to keep counting on funding and someone to show up. But now, things are about to change. I was talking, I think, to David earlier here. I really think that over the next 6 months and so on, if you start looking, for example, at private equity funds, everyone is going to start marking down their investments. I was talking to someone yesterday that it's almost like markets now, they're like the Bon Jovi song, looking for the living on a prayer recovery, right? People are trying to hold on, marking down their investments, hoping that things will get better. Maybe the war between Russia and the Ukraine will will get sorted and things will get back on track, but probably not. And soon what's going to happen? We're going to see lots of private equity funds losing lots of money, lots of the institutional investors, so the LPs that invest in them will get burnt. And this, for entrepreneurs, will be really nasty. It will just force people to be much more focused on what? How to deliver the business plans, to be much better at having business plans that are a little bit more grounded in reality than what we saw. And maybe trying to sell a little bit Rodney's company. And that's why we need processes, right? Lots and lots of companies nowadays, they produce so much data, but they still don't know what to do with it. And okay, in this age of machine learning and AI, it's easy for CEOs to say, look, I have all this data, bring in a data scientist and we'll sort it out. Well, sometimes even asking the right question takes time, right? So if companies, I guess, like Avalia that can quantify and put this to good use, that's the kind of competitive edge that might make the difference between surviving or not in the tough times. And again, I'm not getting anything from me here. I mean,
no, but it's a good point, because not a lot of people know this is possible. So this data is sitting there, and all the algorithms to pull them and see them and clean them. That's the hardest bit, is the most boring bit, is bringing it to what's called a canonical format where you can compare. And, a lot of people don't know this is even possible. So this is not being done, and there's an edge here. Over the years, this edge is going to disappear. It's going to become more commonplace. But for the next 3 to 5 years, this is an edge. Not a lot of people. The people that have the skill to do this kind of work are very few, and they're doing other things. So even when we go to market and we have competition with like IBM or Accenture, great companies. In a past life I worked with Accenture, great companies, but it's just like there are very few experts capable of doing this, and there's so much work to be done that this is not looked at. And what happens with this poor performance, with these delays, and if you've ever been in a board meeting where people are asking the CTO, the CIOs, like, why is this not being shipped? Why is this being delayed again? And that difficult, uncomfortable conversation feels like Groundhog Day, again, you postpone. Why is this happening? There's something deeper that's not being discussed, which is if they're struggling to ship, what they're shipping is probably not very good. And that's the thing that we do here. So this is what we call a scalability test. And we go in bands. And we set up a simulation. And this simulation, we understand the logic of the software, and we build systems that will go through the different paths of the software. So if it's a banking, we'll check your balance, you'll make a transfer, it'll, make an investment, whatever. We'll do different things and touch different databases and different parts of the code. And then you start doing what's called concurrency. So you have more than one user fighting for resources in that system at the same time. They don't need to do the same thing at the same time. They're just during the same period of time making transactions. So you see, there was one user, and this is a real case, by the way, very successful business, okay? Being sold to a bank, had a certain scale, we're going to go 100x in scale. But this bank makes a lot of money, and these guys were making good money. Acquisition, complementary. We go and do this. When you have 2 concurrent users, it's not a lot. You'll start having delays. The system kind of chokes a little bit. It's based on the cloud. A different machine pops up. It has more scalability. You put 4, it's working well. You put 8, and you start having poor performance. And this is against a benchmark of response, right? And it's data from Google. I mean, it's just like, there's a lot of data out there that we can leverage to make these benchmarks. When you get to 64, half of the transactions are being dropped and non-responsive, or just rubbish performance. And when we get to 156, the system is down and doesn't recover. Now, these guys, even though they're making good money, clients are a little bit patient, it didn't work now, we'll try again later. The level of concurrency wasn't that big. It was kind of distributed. So they got by and clients were patient because it's a new business. But now you have a big bank putting their brand on top of a system like this. That's a reputational disaster. And the concurrency will be here all the time. It's not going to work. So then you get, war room, doesn't perform. We just spent $100 million buying this company. Well, did you do the diligence? And going back to the modeling of that system, let's imagine now we're creating 24 million, that's the plan, and we have this 12 million investment in R&D, and we bring this future cash flow to present value, and we get a valuation of about 500 million. I rounded a little bit so it shows nice, right? About 500 million net present value of that cash flow and that investment being brought to present value. Now, if that moves from 4 weeks to 6 weeks, you actually lose half of the value creation. You're less profitable, okay, you don't pay as much tax, congratulations. But, that's not how you make money, not paying tax. In the end, instead of 500 million, you got 340 million of value creation. So when we look at the destruction, yeah, you lost 4 million in costs, you lost 6 million per year in revenue, but in terms of share price, of enterprise value, It's a massive destruction. Massive. And because no one is looking at the data, they're not seeing this. And they were paying these premiums. But now the tide is low. It's time to go and have a look and see what we get. So that's the story here. Some of our clients we have from early stage VCs all the way up to big corporates. Prosus is it's a big investment fund in the Netherlands, for example. They own a third, I think, of Tencent China, and they make investments all over. And work banks, funds, etc. And the UK is the biggest market in Europe. The UK is 50% of the European market when we talk about investments and transactions. So our time to come here is being overdue, and I'm really happy to be here with you today. And that's the story.